There's a reason the grandest building in almost every old town is the bank. Marble columns, gold lettering, a ceiling built to make you feel small. And here's the uncomfortable part. It was paid for with your money, not the bank's, yours. Now stay with me because this isn't a conspiracy video, and I'm not going to tell you to pull your cash out and bury it in the yard. I'm going to draw the actual machine, the one your paycheck disappears into the second it lands, piece by piece. And by the end, you'll see the single number that quietly decides whether your money is working for you or for them. Once you see it, you can't unsee it. And start with that building itself because it's the first trick. The columns, the marble, the vault you can glimpse from the lobby. None of that is for you. It's theater. A bank needs you to feel one thing above all else, safe enough to never ask where your money actually is. The heavier the door looks, the less you question what's behind it. Every choice, from the architecture down to the soft word savings, is designed to make you relax and leave your money still. Hold on to that because almost everything that follows depends on you not looking too closely. Let's start with the most ordinary moment in your financial life. You deposit money. Follow a single $100 bill. You put it in, and on your screen it looks like it's just sitting there, safe, waiting for you, behind thick glass and a heavy door. That image, money resting in a vault with your name on it, is the most successful illusion in modern finance. Because your $100 does not sit. It can't. Idle money earns the bank nothing. And a bank's entire reason to exist is to make sure no dollar ever rests for long. And there's a second illusion hiding inside the first. You think of that $100 as yours parked at the bank, but legally, the moment it lands, it stops being yours. It becomes the bank's. What you own now is just a promise, a line on a screen that says they owe you $100 back. In plain terms, you didn't store money at the bank. You lent it to them, unsecured, on demand, at almost zero interest. You're the bank's cheapest lender, and you didn't even know you'd taken the job. So within hours of your deposit, that $100 quietly walks back out the front door. The bank keeps only a thin slice on hand, say $10, just enough for the handful of people who might come asking for theirs today. The other 90, lent out, to a stranger buying a car, to a couple closing on a house, to a business making payroll. Your money is now out in the world, working 3 jobs at once, earning interest the whole time, just not for you. Here's where the profit appears, and it's almost insultingly simple. The bank pays you something for the privilege of holding your money, maybe 0.5% a year, often less. Then it lends that exact same money out at 6, 8, even 15%. It rents your money from you for pennies and re-rents it to the world for dollars. The gap between those two numbers has a name, the spread. And that spread is the heartbeat of every bank that has ever existed. Picture it as one counter with 2 windows. At the first window, you hand over your money, and they thank you for it with 0.5%. At the second window, a few feet away, they hand that very same money to a borrower and charge him 8. Same building, same dollars, same afternoon. 2 completely different prices. You and that borrower are sitting on opposite sides of the bank's profit, and only one of you was offered the good rate. The wider they can hold those 2 windows apart, the more they make. You just happen to walk up to the cheap one. On your one deposit, it sounds tiny, but multiply it across millions of deposits every single day, and it becomes one of the largest profit engines on earth. For a big bank, the gap between the interest it pays out and the interest it takes in, its net interest income, runs into the tens of billions of dollars in a single year. That is not a fee for a service. That is rent on money, your money and money like yours, collected at industrial scale from millions of accounts that each believe their little balance is just sitting there doing nothing. And here's the sleight of hand at the very center of it. You can ask for your money back any second. It's on demand. But the loans the bank made with it run for years. A mortgage is locked in for 30, so the bank is pulling off something that should be impossible. It's funding decades-long loans with money that could vanish from its hands in an afternoon. It borrows short and lends long and pockets the difference. That trick even has a name, maturity transformation. And it isn't a side effect of banking. It is banking. The bank gets paid for standing in that gap, holding two promises that can't both be true at once: that your money is always there for you, and that it's also tied up for 30 years in someone else's house. And lending to your neighbor is only part of it. The bank also pours those deposits into government bonds, into other banks overnight, into the markets. Anywhere a safe yield is waiting. It even earns on the float. The day or two your payment spends in transit between accounts, when the money is, for a moment, nobody's but theirs. And here's the laziest income of all. The slice it keeps in reserve doesn't even sit in a drawer. The bank parks it at the central bank, which now pays it interest, risk-free, for doing nothing at all. So even the part of your deposit that exists purely to make you feel safe is quietly earning them a return. Every channel points the same way. Your idle dollar turned into their working dollar. But the spread is only the first engine. Watch what happens next, because this is the part most people never see. That $90 the bank lent out doesn't vanish. It gets spent, and it lands in someone else's account at another bank. And that bank does the exact same thing. Keeps a slice, lends the rest. So your original $100 becomes a new loan, and then another, rippling outward through the whole system. Put real numbers on it. Your 100 comes in, 10 stays, 90 goes out. That 90 gets deposited somewhere else. 9 stays, 81 goes out. Then 72, then 65, on and on down the chain. Add up every loop, and that single $100 bill of yours has quietly supported around $1,000 of loans across the system. $1,000. All earning interest, all built on your one deposit. Economists have a strange, almost magical name for this: money creation. And every single loop in that chain pays somebody interest. You started it. You'll never see a cent of it. Where did this even come from? Centuries ago, people stored their gold with goldsmiths who handed back a paper receipt, an IOU you could redeem for your gold anytime. Soon people realized it was easier to just trade the receipts than haul the gold around. And the goldsmiths noticed something dangerous. On any given day, almost nobody actually came to collect. So they began quietly writing more receipts than they had gold, lending those extra paper claims out and collecting interest on gold that didn't exist. That, right there, was the birth of modern banking. We just swapped goldsmiths for banks and paper receipts for the number on your screen. The trick is exactly the same. Lend out money you've promised to give back, and bet that not everyone asks for it at once. And once the bank has made your loan, it often doesn't even keep it. Take that 30-year mortgage. The bank lends you the money, locks you into 3 decades of payments, and then turns around and sells your loan to investors, bundled together with thousands of others. It collects a fee, gets all of its cash back immediately, and uses that same cash to write a brand new loan to somebody else. So it earned on your loan, sold your loan, and recycled the money to do it all over again, sometimes without tying up a single dollar of its own for long. Let that land. You're not even the bank's long-term borrower. Your 30-year commitment was packaged and sold within weeks. To the machine, your loan was never a relationship. It was inventory. Now the second profit engine, the one running underneath all of it, fees. The overdraft charge when you slip a few dollars below zero. The monthly maintenance fee for the crime of keeping an account open. The small cut the bank takes every single time you tap your card. Paid by the store, baked silently into the price of everything you buy, so you literally never feel it. Each one feels trivial on its own, but multiply them across millions of customers, swiping millions of times a day, and the trickle becomes a river that flows in exactly one direction. And some of those fees aren't passive. They're engineered. Take the classic overdraft trick. Say a few small purchases and one big one all hit your account on the same day, and you're running low. The fair thing would be to process them in the order they happened. But for years, many banks quietly processed the biggest one first, draining your balance sooner so that each of the smaller purchases after it also slipped below zero, and each one triggered its own separate overdraft fee. One low afternoon turned into 4 or 5 charges by nothing more than the order they chose to subtract your money. That wasn't a glitch. It was a setting. A deliberate design choice that turned your worst financial day into one of their best. And to the bank, your checking account was never really the prize. It's the front door. Once you're inside, you stop being one product and become a pipeline. The same institution that holds your deposit will sell you the credit card, the car loan, the mortgage, the overdraft protection, the insurance, the investment account. Each one its own stream of interest and fees, all flowing out of that single relationship. That's why opening an account is so easy, and closing one is such a quiet hassle. You think you opened an account. They think they acquired a customer they intend to earn from for the next 40 years. And here's a question the marble columns are designed to stop you from asking. If the bank only keeps $10 of your 100 on hand, where is the rest of your money right now at 2 in the morning? The honest answer is, it isn't there. It's out in those loans, those bonds, that recycled mortgage. The whole system runs on a quiet bet that we won't all ask for our money on the same day. Most of the time the bet holds, because most of us never do. It works on trust. And when that trust cracks, when everyone rushes for the door at once, you get the one thing banks fear most, a run. Because remember, at this point your money isn't even cash anymore. It's a number in a database, a promise the bank can keep only because we take turns asking for it. If even a fraction of us showed up for our money at the same time, the cash to cover it simply would not be there. Not because the bank stole it, but because the system was never built to hand everyone their money back at once. It was built to keep everyone calm enough never to try. So why doesn't that happen every other month? Because of one quiet, brilliant invention, deposit insurance. A government promise that even if your bank collapses, you'll get your money back up to a generous limit. But notice what that promise really does. It's not mainly there to pay you after a disaster. It's there so you never panic enough to cause one. It makes you stop checking. It lets you leave your money sitting, trusting, still. The insurance isn't protecting your money from the machine. It's the very thing that keeps the machine running smoothly, by making sure you never look too hard at it. And it goes further than your one branch. The biggest banks became so woven into everything, every paycheck, every mortgage, every business, that letting one collapse would drag the whole economy down with it. Which means when they make a reckless bet and lose, the same public that was never asked often gets handed the bill to save them. Heads, they keep the profit. Tails, we cover the loss. That isn't a glitch in the machine either. When you sit at the center of everyone's money, you stop being just a business. You become something the rest of us are forced to protect. So step back and ask the question that flips everything. In this machine, what are you? You are not the customer. The customer is the borrower, the one paying the high rate. You, the saver, the one who feels like the bank is doing you a favor, you are the supplier. Your deposit is the single cheapest raw material the bank can buy. They buy it from you for almost nothing and sell it back to the world over and over at a markup. You walked in thinking you were being served. You were being sourced. And now you can see what it costs you. While your money sits earning 0.5%, it's out there earning the bank several times that on the same dollar multiplied across the system. And it's quietly worse than that because of one number nobody at the bank will bring up, inflation. If prices rise 3% a year and your savings earn 0.5%, your money isn't standing still. It's shrinking. Every year it buys a little less than the year before. So the saver parking cash in a normal account isn't earning a small return. They're taking a small, silent loss, paying the bank to slowly erode their own buying power and calling it playing it safe. The difference between what your money earns for you and what it earns for them, compounded over 10 or 20 years, isn't pocket change. On a lifetime of savings, it's the price of a car, sometimes the price of a house. And the strangest part? The machine's most powerful fuel isn't a fee or a rate, it's inertia. The bank is quietly betting that you won't move your money, that the account paying you almost nothing is too much hassle to leave, that you'll keep tens of thousands sitting and checking at basically zero because switching feels like a chore. And they are right far more often than they're wrong. Doing nothing feels safe. But in this machine, doing nothing is a choice, and it's the one choice that pays them the most. So follow a single $100 bill of yours through 1 year and count the ways it worked for them. It earned the spread, lent out at several times what you were paid. It got multiplied through the system into roughly $1,000 of other loans, every one of them paying interest. The reserve slice earned risk-free at the central bank. The loan it became may have been sold for a fee and recycled into another. And every card swipe it ever touched skimmed off a little more. One bill, half a dozen quiet streams of income. And not one of them, in that entire year, ever ran back toward you. So here's the whole machine in one picture. Your money goes in, a thin slice stays, and even that earns for them. The rest is rented out high, multiplied through the system, loaned, sold, and recycled. Fees ride silently on top of every transaction. Insurance keeps you calm so you never move. And every arrow of profit from every engine points in the same direction, away from you. That's not a broken bank. That's a bank working exactly as designed. None of this makes banks villains. It makes them businesses, extraordinarily good ones, that you've been lending to for free your entire adult life. The fix was never anger. It's seeing the machine clearly, because almost nobody does. Money you'll need next week belongs in the bank. That's what it's for, and that's fine. But money you won't touch for years shouldn't sit at 0.5% quietly financing someone else's profit while inflation eats it from the other side. The people who build wealth aren't smarter than you. They didn't find a secret account. They just stopped being the supplier. They took the long-term money and made it work the way the bank's been working yours all along. Lent where it earns, owned where it grows, instead of left still where it's quietly borrowed for free. Because once you can see the machine, you stop being a part it runs on. Stick around. Next, we'll draw the other side of the counter, how the interest on your own loans is calculated and why it's almost always quietly tilted toward the lender. See the machine. Don't be the fuel.